If you hold silver, gold, XRP, or any hard asset right now, what happened in 80 minutes on January 30th, 2026 should be the most important market story you study this year. In 80 minutes, silver shed more value than most countries generate in a year. $1 trillion evaporated, and almost nobody explained it correctly. I'm Bernard, the OG Analyst, and on this channel I break down the real mechanics behind gold, silver, crypto, and macro markets in plain language. No hype, no agenda, just the data and the story behind it. Before we go any further, everything in this video is strictly educational and informational. This is not financial advice, not investment advice, not legal advice. Always do your own research and consult a licensed financial advisor before making any decisions in the market. Precious metals and crypto markets carry significant risk. Past performance does not guarantee future results. Now let's get into it. On January 29th, 2026, silver hit $121.64 per ounce. That was a record, a number that hadn't been touched in over 4 decades, a price that took the market by complete surprise and forced every institution, every hedge fund, and every retail trader who had been short silver to start paying attention very carefully. The momentum looked unstoppable. Industrial demand was surging. The structural deficit in silver supply was heading into its 6th consecutive year. Geopolitical tension was running hot. The gold to silver ratio was compressing. Every signal pointed in the same direction, up. And then, in less than 80 minutes the following morning, silver lost over 30%. Not 3%, not 10%, 30%. The biggest single session drop in 46 years. A collapse so sharp and so fast that even traders who had been watching silver their entire careers said it felt like the market broke. Bloomberg recorded spot silver down 7% in a single session during the peak chaos. The investing.com price timeline tells the story with brutal clarity. Silver peaked at $121.64 on January 29th, opened at $119.25 at 10:30 in the morning on January 30th, and by mid-afternoon had crashed to $78 an ounce. From record high to a generational drawdown in the span of a single trading day. So what actually happened? Because the mainstream narrative either glossed over it or got it wrong. Let's start with the mechanics, because this crash was not caused by a sudden drop in industrial demand. It was not caused by a flood of new silver supply. It was not caused by a change in the fundamental thesis for the metal. What happened on January 30th was a precision demolition of the paper silver market, and it was executed through 3 specific mechanisms working simultaneously. The first mechanism was the CME margin hike. The Chicago Mercantile Exchange, which operates the COMEX futures market where silver is priced, quietly raised margin requirements for silver futures contracts before the weekend prior to January 30th. Margin requirements are the cash deposit traders must post to hold a futures position. When CME raised silver's margin rate from 11% to 15%, and then again from 15% to 18% in a second hike shortly after, it sent a very specific message to every leveraged long position in the market. That message was, post more cash immediately or your position gets liquidated. For retail investors and smaller funds operating with leverage, this wasn't a request, it was a forced exit. Automated liquidation orders flooded the market simultaneously. Goldsilver.com documented this exact mechanism clearly. The margin hike pushed silver from $120 all the way down to $70 in the paper market, a cascade driven not by sellers who believed silver was overvalued, but by traders who had no choice but to close their positions. The second mechanism was the short covering and repositioning by major institutional players. The Reddit Wall Street Bets community compiled one of the most detailed timelines of this event, and it identified something significant. JPMorgan closed approximately 633 short COMEX contracts at or near the intraday low. Think about what that means. A large institutional short position, which profits when prices fall, was closed at the exact moment prices were at their lowest point. Retail traders were being forced to sell. The institutional short was buying their forced sales at the bottom. The paper price was crushed to enable a transfer of position from retail panic to institutional accumulation. This is not a conspiracy theory. The trade data is public, the 13F filings are public, and the timeline reconstructed by market participants correlates the institutional moves with the specific windows of the sharpest price decline. The third mechanism was the Jane Street SLV position. And this one deserves its own conversation. In the fourth quarter of 2025, Jane Street, one of the world's largest and most sophisticated quantitative trading firms, increased its holdings in SLV, the iShares Silver Trust ETF, by approximately 500 times. That is not a typo. From a negligible holding to 20.6 million shares, a position worth approximately $1.3 billion, Jane Street became the single largest institutional holder of the world's most prominent silver ETF. When a firm with that kind of quantitative power holds that scale of a position in a paper silver vehicle, it has the ability to influence short-term price mechanics through hedging, arbitrage, and the natural flow of its own trading strategy. Whether the intent was directional or purely mechanical, the effect of that position on silver's volatility during the crash is impossible to ignore. TradingView, Whale Alert, Rolling Out, and FX Empire all covered this story when the 13F disclosure became public, and the correlation between Jane Street's massive SLV build and the subsequent greater than 30% silver price drop lit up the precious metals community. Now here is where the story gets more complex and where the mainstream narrative completely missed the point. While the paper price was being demolished on January 30th, the physical silver market told an entirely different story. Physical premiums, the price above spot that buyers pay to actually receive silver in hand, did not collapse with the paper price. They widened. In some cases, physical premiums ran $10 to $15 above the COMEX spot price. Dealers were not selling physical silver at $78 an ounce. The physical market refused to validate the paper market's verdict. This divergence between paper price and physical price is one of the most important signals in the precious metals market because it tells you what the real-world supply and demand situation looks like when you strip away the leverage and the derivatives. And the physical situation going into the crash was already deeply stressed. COMEX silver registered inventories, the metal that is actually available for delivery against futures contracts, had been declining sharply. A Kitco report from February 12, 2026, documented a single-day negative adjustment of over 3,250,000 ounces from the registered category. Total COMEX silver inventories, which once sat near 532 million ounces, had fallen to approximately 366 million ounces, a decline of roughly 31%. Meanwhile, open interest in silver futures contracts stood at approximately 152,000 contracts, representing about 760 million ounces of paper silver. The math is stark. Registered COMEX inventory covered approximately 14% of paper obligations. 14%. The first notice day for March 2026 delivery contracts made this tension visible to everyone watching closely. Multiple sources, including a detailed Substack analysis by Jin Lo, documented that 43.1% of March contracts were flagged for physical delivery on first notice day, an extraordinary figure that would strain COMEX inventory severely if a meaningful portion of those contracts were honored in full. Discovery Alert's analysis of COMEX silver default risk described the situation as a potential delivery stress event that the market had not seen at this scale in modern trading history. The 6-year structural deficit compounds everything. The Silver Institute forecasts that 2026 will mark the 6th consecutive year in which global silver consumption exceeds mine supply. Industrial fabrication demand from solar panels, electric vehicles, semiconductors, and data center infrastructure continues to grow while mine supply faces mounting headwinds. Most significantly from Mexico, the world's largest silver-producing country, which supplies between 24 and 28% of global mine site silver. The killing of cartel leader Nemesio Oseguera Cervantes, known as El Mencho, in February 2026, triggered a wave of violence and transportation disruptions across 22 Mexican states. Mining engineers refused site deployments, insurance for silver shipments dried up, and the supply corridors that move silver from Mexico's richest belts to market became blocked, burning, and contested. This disruption layer sits on top of an already deficit market, and it has not been fully priced by the paper market at any point. Add to this the geopolitical dimension. On February 28, 2026, the United States and Israel launched coordinated strikes that killed Iran's supreme leader Ali Khamenei. Major oil companies suspended tanker shipments through the Strait of Hormuz, the choke point that handles approximately 20% of daily global oil flow. Brent crude jumped 13% in a single session. Reuters cited analyst estimates of 8 to 10 million barrels per day of potential supply disruption. JPMorgan and Barclays both projected Brent could reach $100 to $120 per barrel if the disruption held. This is an inflationary shock of the first order, the kind of macro event that historically sends capital into hard assets at scale. Gold responded as you would expect. Spot gold moved above $5,200 per ounce. PAXG, the tokenized gold product, hit a new all-time high of $5,619. Physical gold in China traded at a premium of $282 above international spot, a signal of acute safe haven demand from the world's largest gold-consuming nation. The World Gold Council reported that Chinese platforms ran out of physical inventory as buyers overwhelmed supply. Silver's response was more complicated, because silver is both a monetary metal and an industrial one. When war shock hits, the initial reflex is to buy gold as the purest safe haven. Silver often lags in the first hours of a geopolitical spike, then catches up as the monetary premium reasserts itself. The Investing.com analysis of gold and silver futures in early March described the dynamic precisely, a diminishing war premium in silver's near-term price action, even as the underlying structural case remained intact. This two-speed response creates violent short-term moves that punish leveraged positions but ultimately resolve in silver's favor if the macro thesis holds. For XRP holders watching all of this, there is a direct line between what happens in precious metals and what happens in the broader risk asset environment that includes crypto. XRP was trading around $1.34 in early March, down 26% year-to-date, with Bitcoin near $65,900. The Iran conflict triggered a classic risk-off rotation. Capital moves from speculative assets toward hard assets and safety. Standard Chartered cut its XRP year-end target, and the price action reflected the broader macro environment. This is not a permanent verdict on XRP's fundamentals. Ripple's regulatory position has improved meaningfully, and Standard Chartered's longer-term target of $8 by year-end was already revised upward from prior cycles. But in the immediate term, geopolitical shocks compress risk appetite across the board, and XRP feels that compression before gold does. The Seeking Alpha analysis titled The 5 Sigma Pump, the Zero Volume Trap, and Friday's Bloodbath captured something important about the silver crash that most commentary missed. When a market makes a 5 standard deviation move, a 5 sigma event, at low volume, it is frequently not a reflection of genuine price discovery. It is a reflection of structural vulnerability, too much leverage, too little liquidity, and a margin regime that was changed at the worst possible moment for those holding long positions. The bloodbath, as it became known, erased extraordinary paper wealth in 80 minutes, but it did not change the supply deficit. It did not rebuild Mexico's mining corridors. It did not refill COMEX registered inventories. It did not reduce industrial demand. The fundamental story remained exactly where it was on January 28th. Citi Research, in its forward guidance published around this period, maintained a 3-month silver target of $150 per ounce, with a scenario to $170 per ounce if the gold-to-silver ratio compressed to 32 to 1. JPMorgan's average silver price forecast for full year 2026 stands at $81 per ounce, which is more than double the 2025 average. These are not fringe forecasts. They are coming from the same institutions whose trading desks were active in the January crash. What you should be watching going forward is very specific. Watch COMEX registered silver inventories. If they continue declining below 350 million ounces, while open interest remains above 150,000 contracts, the delivery pressure story intensifies. Watch physical premiums. If the gap between paper price and physical delivery price remains above $10, it tells you the real market disagrees with the futures price. Watch the gold to silver ratio. A ratio above 65 historically favors silver outperformance on the next sustained rally. Watch Mexico. Any escalation in cartel violence or operational suspensions at major mines tightens the structural deficit further. And watch the Strait of Hormuz. Any prolonged closure feeds the stagflation scenario that historically produces the strongest sustained rallies in hard assets. The trillion-dollar question is not whether silver can recover from the bloodbath. History and the fundamentals both say it can. The question is whether you understand the mechanics well enough to separate a paper market liquidation event from a change in the fundamental thesis and act accordingly. That is what separates investors who build long-term wealth through cycles from those who get shaken out at the exact moment the institutional players are buying back in. I'm Bernard, the OG Analyst. If this breakdown clarified the most misunderstood precious metals event of 2026 so far, please hit like, share it with someone who needs to understand what actually happened, and subscribe so you never miss a deep dive like this. Drop a comment and tell me, are you watching the COMEX data, the physical premiums, or the Iran situation most closely right now? I read every single one. Stay informed, stay grounded, stay patient. The fundamentals reward those who understand the setup before the crowd catches on. I'll see you in the next one.